It's not just Turkey. There is a dollar liquidity storm ahead of us. Experts are warning that 95 on the dollar index is the line in the sand, and we're over 96 now. Here's what experts say happens next. It's not just Turkey. We are warned. The dollar liquidity storm is ahead of us. Buckle up. Forewarned, we acknowledge Nedbank strategists Niels Hainek and May Aldea for the advisory. Where will it likely strike next? Answer none. We begin with a brief excursion into the mysteries of the international monetary system and the Triffin dilemma. In 1959, Belgian-American economist Robert Triffin lighted upon a thumping paradox. A nation boasting a global reserve currency carries a unique burden, he observed. It must surrender partial control of its own monetary policy. It must also serve a global master. That is, it must issue a superabundance of currency to lubricate the gears of global commerce. Absent that continuous flow, the machinery could seize, and the world could sink into depression. The issuing nation must therefore be willing to endure vast, sustained trade deficits. The less wares the issuing nation buys from the world, after all, the less currency is available for global duty. As the issuer of the world's leading currency, this is precisely the burden the United States carries upon its shoulders. Explains the IMF, if the United States stopped running balance of payments deficits, the international community would lose its largest source of additions to reserves. The resulting shortage of liquidity could pull the world economy into a contractionary spiral, leading to instability. The dollar accounts for some 87% of overall foreign exchange trades, and over 60% of foreign exchange reserves are still held in dollars. But the burden of global responsibility weighs with time. The U.S. has endured an $11 trillion cumulative trade deficit with rest of the world since 1989. Massive trade deficits are twinned with equally massive account deficits. The United States ran a $466 billion current account deficit last year alone, accounting for 43% of all global deficits. And its foreign debt swells to dimensions beyond all sustainability. According to recent data from TreasuryDirect.gov, the government will shell out nearly $500 billion for debt service this year. A goodly portion of that amount it must pay to overseas creditors. Thus what is good for the world eventually becomes a domestic bellyache. As Investopedia notes, ensuring global liquidity causes a trade deficit for the currency issuing country, but makes the world happy. If the reserve currency country instead decides to focus on domestic monetary policy by not issuing more currency, then the world is unhappy. By this standard, the world is growing unhappy. The world, especially emerging markets, fattened on record amounts of dollar-denominated debt during those heady days of zero interest rates following the Great Recession. Atop this dollar debt, these nations piled additional debt. This huge debt pyramid was fine, Jim adds, as long as dollars were flowing out of the U.S. and into emerging markets. But that situation no longer obtains. The Federal Reserve has been raising interest rates since December 2015, and, as of last October, reducing its balance sheet. The great flow of dollar liquidity is therefore slowing, even going into reverse. A stronger dollar means higher interest payments for nations that took on dollar-denominated debt, and investors are fleeing softer emerging market currencies for the mightier dollar. Fewer dollars are therefore available to service the world's mounting debt and support local economies. The result is an emerging markets crisis, as is unfolding in Turkey and Argentina. Argentina's central bank just raised interest rates to a crushing 45% in order to relieve pressure on its peso. Emerging market woes began appearing late last year, after the Fed began working down its balance sheet, a process that continues apace. Coincidence? Not according to Urjit Patel, head of the Reserve Bank of India. Global spillovers did not manifest themselves until October of last year, but they have been playing out vividly since the Fed started shrinking its balance sheet. The danger, of course, is that the dam busts, and the current crisis spreads beyond Turkey. Forget about Turkey's woes, warned the aforesaid Hainek and Dea. What is the next trouble spot, in their estimation? Asia. Asia is the elephant in the room. We believe Asia will be the next source of downside systemic risk for financial markets, they continue. Why Asia? Asian nations assume the greatest amount of dollar-denominated debt since 2009. Stay tuned, as they say. Watch the U.S. dollar index, warned these gentlemen, which tracks the dollar against competing currencies. 95 is the red line. Anything above 95 spells trouble, they warn. We cannot stress enough the importance of the 95 level on the US dollar index. A confirmed break above this level will mark the beginning of the next risk-off phase. What is the dollar index's present reading? 96.67. Turkey joins Russia in dumping US treasuries. Russia is not the only nation getting rid of their US debt holdings. Here are the details on Turkey's selling of US bills, bonds, and notes. Last month, when we reported that Russia had liquidated the bulk of its US Treasury holdings in just 2 months, we said that we can't help but wonder, as the yuan-denominated oil futures were launched, trade wars were threatened, and as more sanctions were unleashed on Russia, if this wasn't a dress rehearsal, carefully coordinated with Beijing to field test what would happen if/when China also starts to liquidate its own Treasury holdings. As it turns out, Russia did lead the way, but not for China. Instead, another recent U.S. foreign nemesis, Turkey, was set to follow in Putin's footsteps of diversifying away from the dollar, and in the June Treasury International Capital, Turkey completely dropped off the list of major holders of U.S. Treasuries, which has a $30 billion floor, to be classified as a major holder. According to the U.S. Treasury, Turkey's holdings of bonds, bills, and notes stumbled by 52% since the end of 2017, dropping to $28.8 billion in June, from $32.6 billion in May, and $61.2 billion at the recent high of November of 2016. Meanwhile, as we showed earlier, Russia, which first fell off the list last month after being a top 10 foreign creditor to the U.S. just a few years ago, saw its Treasury holdings remain unchanged at an 11-year low of just $14.9 billion. The sell-offs took place well before a diplomatic fallout between the U.S. and both Turkey and Russia resulted in new sets of sanctions and tariffs imposed on both nations. The Trump administration last week imposed new sanctions against Russia in response to the nerve agent poisoning in the UK of a former Russian spy and his daughter. Meanwhile, the Turkish sell-off certainly continued into July and August as U.S. relations with Turkey deteriorated this week after President Trump doubled steel and aluminum tariffs to pressure the nation to release a jailed American pastor. Turkey increased the tensions by announcing new tariffs on American products such as cars as President Recep Tayyip Erdogan called for a boycott of iPhones and other U.S. electronics. And with the anti-U.S. axis started to solidify, with first Russia now Turkey dumping U.S. paper, the question once again is, when and under what conditions would China or others join the all-too-symbolic selling of U.S. government debt? Lynette Zhang, why contagion from Turkey could gobble up the whole world. Lynette explains why turmoil in Turkey could turn global, and she also explains why gold is at all-time highs in Turkish lira. Here are the details. Turkey boasts the 14th largest economy, and they've had easy access to global debt markets. If that debt were issued in terms of lira, no problem, it could be paid off with cheaper lira. Unfortunately, roughly $450 billion of that debt was issued in terms of other fiat currencies, with USD-denominated bonds making up a full third of that debt. Therefore, as the lira dies, that debt becomes impossible to repay. In terms of the USDs, spot gold has been hammered. In terms of lira, gold is at all-time highs. In reality, physical gold is simply providing its most important function, protecting wealth.